Alright folks, welcome back to another episode of Matt Money. Today we're going to be just talking about some of the purchases that I've made over the past, I guess, 2 weeks or so. I think the last time I updated you guys was the third or fourth week. So I think there are some purchases that I made on the 23rd, which I may or may not have already disclosed to you guys. So if not, it's just three purchases. Then I made a couple purchases on the first of the month just based off of additional capital that I'm adding into the fundrise account, the Robinhood account, the M1 Finance account, and just some normal investments in the individual brokerage account as well. So appreciate you guys stopping by. Quick roundup, I guess. March, I just cleared off of the table, and we made about $2,200 or so in passive income. 1,400 or so of which was from dividends. Just checked today, about 390 or so was from YouTube income. So I appreciate you guys continuing to support the channel. Although I want to mention that 70% of you guys over the last 28 days that have been watching these videos aren't subscribed. So if you guys do enjoy the channel and you do enjoy the content, make sure to hit the subscribe button so you guys get notifications when I make a new video. And then the other remainder of that was coming from Shopify income from some of the other passive income sources that I've created with Kyle, Passive Income Investor. So just a brief rundown of what happened in March, and we'll kind of run through what's going on so far in April. Currently, S&P 500 is about flat for the past 5 days. So last Friday closed at around $250 of a share for the SPY, or 2,500 if you're looking at the S&P 500 as a total. I generally use the SPY or the S&P 500 as my gauge for the market. Some folks use the Dow Jones. I personally am a fan of the S&P 500, top 500 stocks by value, and I guess just trust in the United States stock market. So I generally just go by those 500 companies, and then sometimes it's 502, 503, but regardless. So hoping tomorrow might be an up day or positive day and we remain flat for the week, because we are slightly down. If you were to start at Monday, we did kind of come up a little bit into the 260-ish range, and now we are down 10 points or so to the 250 range. So no big drastic movements and no crazy volatility like we've kind of seen over the past couple weeks with up down 10% movements that we've seen in the past. These are slightly smaller 5% movements, so hopefully we'll continue to oscillate a little bit smaller as we continue to go on. Whether or not that ends up going up, sideways, or down, who knows, but it is what it is. And then hopping over to Brent oil, or WTI oil, depending on what you guys look at. Up slightly, about 20% over the past couple days, so it did bottom out close to around $19 if you're looking at West Texas Intermediate, and it's back up to about $24, $25 or so, just based off of Trump having a conversation with the Crown Prince of Saudi Arabia, saying that basically there's potential to cut up to 10 million barrels. Whether or not that actually happens, who knows? It could just be a optimistic discussion, optimistic tweet, and we'll see when they actually have an emergency meeting, just like the Crown Prince said they would have. They would schedule an emergency OPEC meeting to cut prices. For those of you guys that are in the UK and maybe on the Eastern Hemisphere, Brent crude is probably your benchmark here, so it's just under $30 a barrel. And for those of you guys that work in the Gulf of Mexico, like I used to, probably quote yourself to this Mars US, I guess, type of oil here. It's around 21 bucks or so. So slightly trading at a discount compared to WTI. You folks in the Permian, I think you guys are getting closer to $14, $15 a barrel, just based on the fact of capacity constraints and the costs to basically get your oil out to wherever it needs to go. So it's slightly challenged at the moment, continued challenged environment with respect to oil price. That's kind of what I track. So that's kind of my job and what I track on a day-to-day basis. But now I deal mostly in gas now that I'm here in Trinidad, but it is what it is. So hopefully things continue to look up for those of you guys that are long energy stockholders like myself and some of you other guys on the channel. Quick news here is we did actually get my K1 form from Cardone Capital. So give me a little bit to dive into that, and we can hopefully have a good discussion about it. But it is pretty promising, some of the initial results, if I understand them correctly. of what is basically happening here and the amount of real estate I potentially control with my $15,000 investment. So more to come on that as we kind of dive deeper into that in the future. But now, kind of getting more into the recent purchases that I've been kind of making since the end of February timeframe. So, overall dividend yield of these companies is around 6-7%. Although I'd like to mention that there are some dividend cuts in here into some of these stocks already, specifically Boeing, Carnival Cruise, and Royal Caribbean, which we'll kind of get into some recent purchases that we've had in the portfolio. And specifically starting with some of the stocks that I purchased on the 24th of March. Not sure if I covered these already. So really quickly, just want to cover those. Bought 500 shares of Cosmos Energy. It's a small exploration production company, mostly big time exploration. They generally go for very big play opens or access that a lot of people won't do that. So it's somewhat risky in that respect, but have been thus far very successful in playing, opening up new plays in Ghana and a lot of other places in West Africa, and also looking to open up some places in French Guyana as well, in South America. So they're kind of hanging out on that sort of access barrier between West Africa and Northeast above Brazil, sort of underexplored areas. So potential for huge returns if they are able to do some stuff. I know Cosmos is one of the big partners in a big gas discovery off the coast of Mauritania and Senegal. So they farm down on that, but they hold a pretty decent chunk of that. It's got some pretty good cash flow to be coming online in, I believe, late 2021, early 2022 time frame. So that should help stabilize some things. It's a FLNG plant that'll be kind of coming in, and curious to see how that goes in the future. Bought some small cap S&P 600 iShares. Nothing too crazy with that. Just 4 shares in the YouTube Moolah account for $200 or so. So can't really complain with that. Bought some Visa when it hit down to that $136 range. So can't complain with that. That's a good price. Can't complain with that at all. I generally only buy Visa in the M1 Finance account, but had some extra cash and couldn't basically wait to jump at the price of $136. So I bought 200 shares or so, which I don't know how much that actually really cost me, but 20 times 136, I guess. So, just under $3,000, I guess. But ended up being a pretty good purchase and already up $418 or so, but don't really plan on selling this one for a long time. Doesn't have a very big dividend yield or anything like that, a little bit less than 1% if you're kind of looking at it, but I'm not really buying it for the dividend. The dividend's nice and they grow it really quickly, on the order of about 20% or so a year over the past 5 years or so. But really holding it for growth and I guess a little bit of dividend income. I can't complain with that. I mean, if they're able to continue to grow it at 20% rates, it's not going to be too bad in the 10-20 year range. And I don't really think Visa, MasterCard, or American Express are going anywhere anytime soon unless there's some sort of drastic change in the way that things are going. A lot of people might be thinking, well, what about mobile payments? Well, generally speaking, Visa owns a lot of those mobile payment users that you're already kind of using, Cash App and other ones that you're kind of using to help pay friends back and forth. So can't really say that that's going to really to take away from their normal volume. Now we're getting a little bit into some of the riskier plays. So generally speaking, I would say the portfolio has been relatively well hedged, other than the fact that it's heavily exposed to oil. So Carnival Cruise is back down at 52-week lows over the past 2 days. So figured I would join my friend who joined at about a little bit over $8. I think his cost basis is $10 for Carnival Cruise, and figured I would jump in as well. So I bought 100 shares at 168 or 860 or sorry $8.68 a pop, so $868 in total, and bought Royal Caribbean for a little bit more than that, $1,000 or so. So only about 40 shares of Royal Caribbean, but overall I can't necessarily complain. I do like Carnival Cruise a little bit more just based off of the books than Royal Caribbean. I know some of you guys are going to hit me hard on this one, but it's a long-term play. I'm a long-term investor, and so I looked at the balance sheets and I said, you know what, maybe it takes 4 or 5 years to kind of get back into it. I looked at their interest payments. The interest payments on a yearly basis really weren't that much, and actually Royal Caribbean's interest payments were about the same as Carnival Cruise Line. So I was relatively surprised to see that. I preferably think that Carnival Cruise is a better buy at this point, just based off of overall balance sheet, and I think it's been hit the most. They're both valued at the same market cap. So where is market cap on here? I don't have it. Maybe it's a little bit further. But when I was looking at these yesterday, one was about 5 billion, one was about 6 billion, and they both are making on the order of like 8 billion or so in terms of, or sorry, 2 to 3 billion dollars or so in terms of net income. So that being said, they're trading at a normal price to earnings ratio of less than two. And granted, I know that's going to be depressed over the next year or so, just based off the fact that the volatility and the kind of issues that we're seeing in the market right now. But I think in the long term, I was willing to have a 5 to 10x sort of growth in some of these positions in the long term for, let's just say, $2,000 or not even $1,800 of capital outlay. So the way I was looking at it was, these kind of are down 80, maybe even closer to 90%. Let's just take a quick look from their all-time highs. So about 85% for Carnival Cruise and 81% for Royal Caribbean. So I said, you know what? If I can 5x my money in a couple years, I'm fine with that. And eventually the dividend will probably not be suspended anymore. So that being said, I was comfortable in the long term getting that kind of back. Had a dividend come from Wells Fargo, so I basically just reinvested that back into the company. Same with BHP. Bought a little bit more BHP at a pretty good price at about $29 a share, slightly up about 5% on that already. Wells Fargo just continued to try to get my cost basis down, up over 300 shares on this one at the moment, which is over $600 a year in dividend payments. So I just want to continue to gain as many shares as I can of Wells Fargo, which is a phenomenal business. Get my cost basis down, hopefully into the 30s. I think right now I'm in the mid 40s. So if I can continue to get it down to the mid 30s, I'll be cruising for a very long time. And if it kind of stays in this place for the next couple months, I'll be continuing to buy and hopefully get myself down to that mid 30 cost basis over time. But one more share, one and a half more shares of Visa in M1 Finance. That's the normal $250 a month, or sorry, twice a month that I'm putting in. So I've been buying about $500 a month of Visa over the past couple months. Relatively happy that the share price has gone down. I remember when I first was buying Visas in the 160 range, jumped all the way up to over $200 a share, and I was like, ugh, really? And now I'm kind of happy again because it's kind of back into a price that I would love to buy Visa at. Granted, it's not the best price. It's still trading at somewhat of a premium if you were to kind of compare it to other stocks, but I know it's one of those high quality stocks, so I'm willing to purchase that. No problem, no problem. GM, I kind of do this as a speculative play as well. I think that they're going to struggle in the short term, obviously, with the volatility that we're seeing in the market. But I think that in the longer term, 2022, 2023, when things kind of get back up and running and some of their electric vehicles start coming out, I think that they're going to give Tesla a run for their money. I don't think a lot of people are really counting on GM to kind of come in and take a piece of market share. But you have some of these good name brand cars like the Tahoes, the F-150s for Ford, the Silverados, that if they start making these in an electric version, and eventually people I know are going to buy them. I know my father is a huge Silverado fan. I love Tahoes. If they come out with an electric Tahoe for a reasonable price, I'm going to buy it. I miss my Avalanche. I used to have a Chevy Avalanche, so they came out with the electric version of that, or even the electric version of the Hummer. I mean, those are iconic companies and cars that I've kind of grown up with. So if they just electrify them, make them EVs, that's something that I think a lot of people aren't really paying attention to, is that, they don't necessarily need to make a brand new model or Bolt or a Volt or anything like that. They just need to electrify their current vehicle stock, and people that love Tahoes are going to love those versions as well because it's the same kind of car, just maybe a different engine. And I think a lot of people don't really even pay attention to the engine. Of course, the motorheads and the petrol heads will love the engines, and they'll miss that sort of naturally aspirated V8 that some of those cars kind of have. But I think that this way that cars are kind of going in the future, and I think a lot of people are discounting it. So I've been slowly accumulating some shares in my Robinhood account, currently up to about 20 shares. I think about mid 20s or so cost basis. We'll kind of see when we get back over into the normal spreadsheet here. Then you have Southern Company, which I've slowly been accumulating shares as well. I think I'm up to 12 shares or so now. So pretty happy with that. Continuing to just slowly accumulate shares, trying to get that cost basis down. Yield on cost just under 5%. So really good company to hold. This is actually utility. So let me switch this really quick, and we can kind of jump right over to the main spreadsheet that we kind of have. So up to around $378,000, so pretty good. Can't complain with that at all. Still down about 63,000 from all-time highs. That's fine. Just accumulating shares as we go, month after month. And let me just refresh this really quick, if you guys don't mind. Really happy with where we are in the portfolio. Like I mentioned, there are some dividend cuts that are in here already. So Carnival Cruise is in here, which I've counted in my 2020 income, but I'm not counting it out for my 2021 income, just based off the fact that I think that it'll kind of come back. And I think that it's kind of just suspending dividends at the moment, but I don't think that it's going to cut them forever. I think they'll be in a short-term cash crunch, but things will turn around, I think, in the next 6 months to a year as people kind of go back to normal. So if you kind of consider that, 2021, we're looking at about 14,500 or so in terms of dividends. That being said, we're still going to be kind of stuck in this 14,000 or 13,500-ish range for 2020, just based off the fact that some of these companies are good to cut the dividend for sure. So we're really starting to struggle to find that extra $450 that the 2020 goals are kind of looking for in the short term here. But like I mentioned, I think that a lot of these are going to be long term, come back, like my Carnival Cruise, my BA, and my Royal Caribbean. So have no, I guess, issues with that. But one of the things that I definitely wanted to look at before we hop into how many shares I have, I guess, of some of those key companies that I mentioned, and also a watch list of some of the other companies that I want to buy, is a quick overview of the sectors that I have. So just going by capital allocation by sector, currently about 18% for energy, 15% for financials, excuse me, 16% for real estate, 9% for healthcare, 9.4% for industrials. So those kind of round out the top 5, 6 sectors here, and it's closely followed up by more of a telecommunications that's kind of coming up as well. And materials is still a little bit small. We currently just have BHP and LYB as the main culprits for that. Cash is continuing to grow into the portfolio. About 7% of the portfolio right now is in cash, just kind of waiting for any further opportunities, or in the chance that I end up getting laid off, that I need that cash to live. And income's not too different from those. You still have the energy, financials, and real estate kind of holding up and supporting the portfolio in terms of the cash flow basis. Yeah, that's relatively it. One of the cool things is that we do have a dividend yield below 6% again. So that kind of shows that the market is getting a little bit more into rational territory. Granted, I'd love to see this come back into the 4% range, but if I can continue accumulating shares at these kind of elevated dividend yield, I'm not going to shy away from that for sure. So pretty excited about that. But one of the things I wanted to look at here is quickly just showing the positions that I might have accumulated in Visa and Wells Fargo. So currently, yeah, we're at about $45 for price paid per share, up to 306 shares at the moment of Wells Fargo. Wanted to look at BHP. We currently have 146 shares at a cost basis of $22 of BHP. Phenomenal company, already up 80% on the entire position, and just got another dividend that I used to buy more shares, so I can't complain with that. Love this company for sure. Going to continue to buy it if the price is right. So yeah, there's that one. What other positions have I bought? Visa, this position in my M1 Finance is down to $181. It was creeping up to close to $200. So happy that we're able to get another 14 shares. So in total, about 34 shares of Visa. So that's pretty cool. Love to get that total position up to 100. GM total cost basis at the moment is around 23. So we have 20 shares at $23. So it's a relatively small position in the portfolio, but hoping to continue to grow it as well. Have some Royal Dutch Shell in here at $52 a share. I should probably buy some more, get that cost basis down. But looking at my normal Royal Dutch Shell, cost basis there is $40. So we're only down, if you look at that one, 6%, 7%, which is phenomenal considering it's taken a pretty big hit. Granted, it has rallied about 20% or so, maybe closer to 40% over the past couple days or so. So some of that is based off the fact that I did buy some of those shares at the depressed prices. I believe my initial position was in the 50s for sure for cost basis. But now it's kind of come down into the 40s. So if it dips down again, I'll probably buy some more, but I'm kind of fearing the fact that I have way too much energy stock, whether it's Exxon, whether it's Shell. So can't complain with that at all. Going to continue to probably buy some more. And then Southern Company, cost basis here. I don't think I've updated this. Maybe I should, because at the moment it still says 59. I wouldn't be surprised because I was buying shares at the high 60s range before utilities really started getting hit in here as well. But yeah, relatively decent of the portfolio. Exxon is looking pretty dismal, if you ask me. I've been buying more shares, but I was starting to buy in the 70s, and so any additional shares that I buy really need to buy at a relatively depressed price to kind of move this cost basis down. I have 202 shares at the moment, so can't complain with that. Pays me a pretty healthy dividend of close to $800 a year, but yeah, uh, this isn't looking too good with respect to the current cost basis, down about 36%. But like I said, I'm going to hold that bad boy for the long term. I think they'll be okay. They have great downstream assets that'll kind of hold up the price and hold up the dividend as well. What other ones did I really want to look at? Oh, I wanted to look at my my watch list here that I kind of came up with, and I forgot to add one more that if it wasn't in my Roth IRA, probably would have already added to, but that's not an excuse. That's just me talking myself out of it. So aside from the ones that I've been buying, there's probably 5 or 6 other ones that I really wanted to highlight and buy as well. That being Apple, Microsoft. I'll continue to buy Boeing if it goes below 100 again for sure. Facebook is one I'm definitely keeping my eyes on. If it dips back into the 130, 140 range, I'll probably be buying a little bit of that. Google, I've been continuing to buy. I'm up to 5 shares at the moment of Google. So yeah, can't complain with that one. It's always been good. If Tesla dips back into the 300s, I'll probably take a look. One of the stocks that Jim Cramer was looking at was Home Depot, and I agree with him. It's a pretty good price. A lot of my friends have been picking up Starbucks, PPC Ian as well, picking up Starbucks. McDonald's is another one that PPC Ian picked up as well. I believe McDonald's is a good one, down from recent highs of 200 something. So it's down a pretty good penny, probably over 30, close to 35% if you were to look at it that way. We are down 27% from its all-time highs there. Then you have Coca-Cola, which is in the 43 range. I think 43 is still too high, so I personally think even though it's down about 26, 27%, you're paying a really big premium to get it when it was at the $60 range. Personally, maybe it's just me being biased, but I'd prefer to own Pepsi than Coca-Cola. It's a slightly more diversified company because it has more of the chips and some of the edibles part of the business rather than strictly soft drinks and waters that can be purchased. So maybe that's just my bias there. Then you also have Amazon, which is only down 12% from all-time highs, so I would look at that one as well. Then you have Disney, which I think is a good price. I'm upset that it's already up 22% from its all-time low, and not all-time low, but 52-week low rather, of $79. Wish I had bought it at that. Some folks I know did, but all these companies have kind of come up pretty significantly from their all-time low or the 52-week lows. Specifically, Amazon's up 18%, Coca-Cola is up 21%, McDonald's is already up 30% from its lows. $124. Wish I had picked some up then. Starbucks was just at $50 a share, $30 or 30% up. Home Depot is already 30% up as well. Tesla's up 150%. Keep in mind it dipped down below 200 for probably couple weeks or so, maybe a little bit less than a week, and then it jumped right up to 220 again. It was kind of hanging out there until it started its rally up to the 900s that we saw. But keeping that in mind, we're down over 53% from that all-time high of over 969. Which is pretty crazy. And then Google's up 10% from all-time or 52-week lows as well. I'd consider picking up more Google if you can get it below 1100. To be honest, if you don't have any, I think this is a phenomenal price to get it at. If you have more, maybe just wait till the cost basis comes down a little bit. But even still, if you don't have any Google, it's something that you should probably consider. Facebook's only up 15%, but for some reason I can't pull the trigger. Maybe tomorrow I'll buy 10 shares or something like that. I mean, a small position, but I'd rather have some shares and ride with it and have some stake in the company than not have it at all. So I just need to kind of get over myself. If you bought Boeing at the right price, you're up 40% almost at this point. Microsoft is up 31%. This $118 isn't recent. This is actually close to 9-10 months ago at this point. So Microsoft's just been on an absolute tear, catching and actually surpassing Apple in terms of market cap, and it's actually still the largest company at 1.2 billion or 1.2 trillion. I'm sorry, dollars at the moment. So Apple's still hanging up and hanging on to its $1 trillion market cap, up 44% from 52-week lows. I don't think it dipped down to 170 in this most recent dip. So I think this is just the fact that Apple and Microsoft have just been on a complete tear over the past couple months and past year, honestly. So don't know where those earnings really came from, but they're just both absolutely exploding. And if you were to look at them on a price to earnings basis, Microsoft's a little bit down, but I think earnings will continue to expand as more and more people are working from home and working on the cloud. They have a really good Office suite that you can use on the cloud, which is subscription based, so that will increase earnings for Apple. Whereas Apple, I think in the short term, is going to take some impacts just based off of the recent issues that they've kind of had, based off of closing and supply chain issues. So yeah, that's relatively it. Really thinking about picking up some of these companies that I mentioned. Obviously, I picked up some of those ones that I already picked up and showed you guys. I'm long all those stocks, so full disclosure on those. And these stocks, the only one I own of these is Boeing and Disney, and potentially going to open up a position in some of these, most likely Facebook, over the next couple days. So full disclosure on that. Really hope this video finds you guys great. And if you guys have any questions, let me know in the comments section down below. Would love to talk to you guys about it. And appreciate you guys stopping by the channel. Look forward to talking to you guys soon. Cheers.